Hey, it's Tom here and welcome back to the channel. So inflation is currently one of the hottest topics in the investing community, and for pretty good reason. Back in 2020, the US Federal Reserve printed around 20% of all US dollars currently in circulation, and the money printing really hasn't stopped in 2021. We're also seeing super hot commodity prices, whether it's steel or lumber or even milk here in New Zealand if you're a dairy farmer. Things are at or approaching all-time highs, and many of the stocks that trade in the stock market in those particular industries that have their profitability very strongly linked to commodity prices are also trading at very high prices compared to where they've been historically. Add into the equation that the Federal Reserve also recently announced that inflation was higher than they had previously expected. It all seems like a little bit of a scary mix, and although I tend to be an investor that focuses largely on individual businesses, hearing other very smart investors like Lee Lu recently in a talk he did with value investing professor Bruce Greenwald, he basically said that although you should spend the vast majority of your time as a value investor focusing on individual businesses, when things get extreme you should pay attention, and I think we're in one of those scenarios right now. So in this video I want to basically give you some of my thoughts on how I personally am going about hedging inflation. I will let you know up front that I'm really not taking the traditional route here, so if you're interested in watching a video that kind of pumps gold stocks or tells you to go out and buy precious metals or Bitcoin, this is not the video for you. But if you want the perspective of someone who is trying to invest their own capital for the long term and has inflation kind of in the back of their mind, I hope this is a nice practical guide and a video to help you through some of your thinking on the topic as well. So I do hope you enjoyed the video. If you do, please hit like and hit subscribe. It does help the channel out a lot. But for now, let's get straight into it, and I hope you enjoy. Now in this video, I basically want to talk through 3 different methods of hedging inflation, and these are not going to be, like I say, your traditional ideas of going and buying a gold miner or putting all your money in precious metals or anything like that. So firstly, I want to spend a little bit of time talking about why these 3 sort of methods or approaches that you can take to hedging against inflation are not the traditional buying gold miners and buying precious metals, because I think that traditionally when we have had hyperinflation, for example, and things have just gotten crazy, those have been quite successful ways to hedge inflation, buying gold miners and buying gold and buying silver, maybe even buying Bitcoin here in 2021. But I think that over the long term, those are not good investments. And that's really the core reason why I don't use those as tools to hedge against inflation, because if you listen to the Federal Reserve, they will tell you that they think inflation is transitory, and this is kind of just a short-term consequence of reopening up supply chains after global lockdowns. And you really sort of have this ongoing argument of, is it transitory or is this real inflation that is going to persist well beyond supply chains opening back up? So as that argument continues to happen, you tend to see more and more people who are convinced there's going to be inflation getting into some of these traditional hedges. Now, the problem for me personally with these sort of traditional types of hedges is that they can be expensive if inflation doesn't turn up. And what I mean by that is, generally speaking, you're buying into either a non-productive asset. If you're buying one of the precious metals, that's what you're doing. These are assets that don't produce cash flow, and yes, they can work very, very well in short, concentrated periods of time where there is inflation and gold prices spike up or whatever it might be. But over the long term, the long run returns from these assets are not good, whether it's buying into the metals directly or whether it's buying some sort of commodity producer like a gold miner or a lumber mill or whatever it might be. These are generally businesses that don't have high returns on capital and don't produce large amounts of cash flow relative to their assets over a long period of time. So the problem from my perspective with investing in those things from an inflation hedge perspective is that if we don't see inflation, there is a significant opportunity cost to buying into those businesses. You can get into the companies when everyone's kind of scared of inflation and maybe prices are starting to move up a little bit, and when inflation just doesn't show up, you've really missed out on a lot of better quality businesses, the long-term compounders that we'd all love to have in our portfolio, that you could have bought at much better prices had you not sort of wasted time, I suppose, in investing in these commodity type businesses. So that's why I personally am not a huge fan of the traditional sort of inflation hedges, but I want to give you 3 examples of other options that you have that in my view are just much better approaches generally, and you really don't have that sort of hedging risk where if inflation doesn't turn up, you've had this huge opportunity cost and you've missed out on the compounding nature of owning better businesses. Now, the first way that you can go about this, and largely this is how it's sort of structured in my portfolio, is to buy into businesses that have pricing power. And basically what that means is if you buy into a really high quality business that has a moat, very much Warren Buffett style businesses, generally these companies have the ability to move their prices up either in line with inflation or perhaps even greater than the rate of inflation. So on that list you have businesses like Apple or Coca-Cola or Monster Beverage. These are all companies that people are willing to pay a premium for and are able to move their prices up for their products over time. And one good example of that in a country that has actually experienced a lot of inflation over the past few years is a business called Coca-Cola ISEC. And this is actually a Coca-Cola bottling business in Turkey. And if you look at the Turkish lira as it compares to the US dollar or the New Zealand dollar, if you're watching from here in New Zealand, you'll see that the Turkish lira has deteriorated substantially and that country has been through a lot of inflation. And it's a phenomenon that has really scared a lot of investors away. And this is a business, Coca-Cola ISEC, that I first came across from hearing it mentioned by Monish Pabrai in a recent talk with SumZero. Now, in that talk, Monish Pabrai basically argued that the inflation that people are experiencing in Turkey does not matter for this business, for Coca-Cola ISEC, because they have purchasing power. And you can actually see this in the business's financials. As the Turkish lira has deteriorated against other currencies, Coca-Cola ISEC has simply been able to push up their prices. And I will put up a screenshot here of some of the revenue and earnings out of that business. And you'll see that from 2017 through to 2020, the revenue for that company went up 71%, the earnings for the business went up 523%, and the Turkish lira currency was down over that same period of time about 50%. So you've had a huge amount of inflation compared to the US dollar. The Turkish lira is down by half. You've lost half of your purchasing power in only 3 years, yet the business has been able to increase its revenue over 70% and its earnings over 500%. So buying into one of these great businesses that is able to push their prices up either in line with inflation or even at a higher rate than inflation is a really, really useful way to make sure that you don't lose the purchasing power of your dollars over a long period of time. And the great thing with buying into a business like this, and this is not a stock tip or recommendation or anything, it's just kind of an example of a great business. But the great thing about buying into a company like this is if inflation does not turn up, you're not stuck in one of these gold miners or commodity businesses where the price can just fall through the floor and the investment thesis is kind of broken. At the end of the day, you still own a very good business with good margins. It slowly grows over time. And it's just a great company to own over the long term. So that is a much better situation that I would prefer to put myself in personally versus the commodity businesses or just buying a precious metal. Now, the second thing I'm going to add to this list, and this might sound kind of unusual coming from someone who's a bit of a Warren Buffett fanboy, because you often hear Warren Buffett talk about how he doesn't particularly like to borrow money, but the example I'm going to use here is having fixed rate debt. Now, debt in a lot of ways is basically just a way of shorting currency. It's basically borrowing money in today's dollars and paying it back over, say, 30 years if you've got a 30-year mortgage, and you're paying it back in tomorrow's dollars, which is a fantastic way to set yourself up if there's going to be a lot of inflation. If you're in Turkey and you borrow some money in 2017 and you borrow, say, $100,000 and then you have to pay that $100,000 back in 2020, you're only giving away half of the purchasing power that you would have been giving away back in 2017, because like we just talked about, Turkey has experienced a lot of inflation. Now, unfortunately for me here in New Zealand, we can get fixed rate debt, but we really can't fix it for a long period of time. Traditionally, you can only fix your mortgage, for example, for up to about 5 years. I would love to have access to the 30-year fixed rate mortgages that individuals in the US have access to. But if you can access these types of products, you can get yourself in a very, very good position to not only protect yourself from inflation, but in fact benefit greatly from inflation. Real estate traditionally has been one of the most inflation-proof assets out there, and if the price of your home, for example, is going up at the rate of inflation, or maybe even slightly above the rate of inflation, similar to our Coke bottler example we talked about before, that means that the value of the asset, the value of the house that you might own is going up, whereas your debt is basically staying the same or getting paid down at that fixed rate. And like I said, that amount of debt basically becomes less in terms of giving away purchasing power, even though the dollar amount might remain fairly similar, because we're having a lot of inflation and, you know, those dollars are sort of being eaten away and becoming less powerful over time. So that can put you in a really strong position. If you have an asset price going up and your debt basically standing still, that's a great way to grow equity. But the important thing here is to make sure that that debt is at a fixed rate, because anytime that we do have a lot of inflation, oftentimes in conjunction with that, we have interest rates go up. And the last thing that you want if you're trying to hedge against inflation is to put yourself in a position where all of a sudden your repayments on that debt go up as well. So if you can fix that debt and you have the asset price going up, you know, your house price or whatever it is following inflation, that's a great way to grow equity. And that's my second example of hedging inflation in a sort of practical way. Now, the third and final way that I would go about practically hedging inflation, or perhaps this is maybe just something to look at when you're trying to apply the first two criteria, so when you're trying to buy into a business with pricing power or you're looking to take on fixed rate debt, is to make sure that the businesses or the assets that you're buying into have fairly modest requirements for you to reinvest capital, or for the business to reinvest capital. So what I mean by that is, let's take the gold miner example. So let's say that you threw some of my earlier ideas out the window and you did go ahead and buy into a gold miner as a way to hedge inflation. Now, if that gold miner is fully set up, has done all of their capital development and all their capital spending already, they're fully set up to just ramp production as high as they can possibly get it, that is going to be a really good inflation hedge. Now, that can work really well as an inflation hedge if inflation does turn up, gold prices shoot up, and suddenly the profit margins from that gold mine just look spectacular and they print money, essentially. That can be a great way to go about it. But one of the situations that you do not want to get yourself into is you buy into a gold miner that has set themselves up to operate at, say, half of the capacity that they can potentially get to, and they can add capacity later, but it would cost them a lot of money to get that extra capacity set up. So they're going to have to spend a lot of money into the future to get a mine up and running, as an example. Now, one of the things that is really going to kill that investment from an inflation hedge perspective is if we do see inflation and if gold prices do shoot up and then this mine goes, oh crap, we should really probably turn on some more production to take advantage of this, the price of getting that extra capacity up and running is also going to have gone up. You can imagine that if you're in the middle of a gold rush and you're a spade salesman, then you'd probably be making quite good money, because all these gold miners would be willing to pay you a lot of money to buy that spade or that shovel off you. And it's kind of the same thing if we see a lot of inflation. If every gold miner is trying to turn on a lot of production, suddenly demand for equipment and the prices of equipment goes massively through the roof, and you really lose a lot of the benefit that you would have had if you had already done a lot of your capital expenditure. And the same thing goes for a lot of these good inflation hedge, high quality type businesses I was talking about earlier. So if you buy into a Coke bottler, but that Coke bottler has still got to spend a lot of money to, say, double their production, maybe they're looking to open a new plant. If we do see a lot of inflation, the price to open that plant is also going to go up. If you are in a real estate business and you're doing a lot of redevelopment, say a Sharesight growth properties, for example, the cash you're going to have to outlay in order to develop those new properties is probably also going to go up. The nice thing for Sharesight is they happen to be sort of funding those redevelopments by selling existing properties. So if the price of the existing properties is going up and the cost to build the new ones is going up, there's sort of no net change, but it's something to keep in mind. If you really do want a pure inflation hedge with some of these investments, ideally you want to have all of that capital expenditure basically out of the way. So that's it from me on inflation. I do hope you enjoyed the video. Perhaps not your traditional approach to hedging inflation with buying precious metals and gold miners and all this crazy stuff, but I think it's a good practical way to go about it. So I do hope you enjoyed those thoughts. If you did, please hit like and also hit subscribe. That does support the channel a lot. But that's it from me for this one, and I'll see you in the next video. Cheers.